Remember the nursery rhyme about the girl with the curl in her hair? When she's good, she's very, very good, but when she's bad, she's horrid. Returns from small cap investing are very like the girl. Recently, they've been very, very good. This chart shows the average annual premium, that is the difference between large cap and small cap returns, from the millennium to the end of last year in various world markets. As you can see, in the vast majority of cases, the premium has been positive, in some cases handsomely so. But there have been prolonged periods of horridness too. For instance, small cap returns were poor between around 1984 and 1997, a time when the rest of the market was booming. So should investors worry about this next chart? This shows how returns from large caps and small caps in the US diverged last year. These are MSCI indices, but if you did the same charts with the Russell 2000 for small caps and the S&P 500 for large, it would look pretty much the same. Small caps ended the year underperforming large by over 5%. You can see that the divergence began in earnest round about here in September. So what was special about that month? Well, there was a lot of turmoil in emerging markets during the summer. And as the fourth quarter progressed, markets became more convinced that the Fed was going to raise US interest rates. Perhaps investors just preemptively reduced their risk exposure. But that doesn't explain why small caps did beat large caps in 20 other major markets around the world, or why they failed to do so in 2 other countries that cut rates rather than raising them. Perhaps instead it's down to relative sector weightings. In the United States, biotech stocks are down around a third since September, and they account for almost 14% of the Russell 2000, against about 4% of the S&P 500. It cuts the other way too. In the UK, small caps didn't have a great year in 2015, but then again, it wasn't hard to beat the large cap index, which is dominated by underperforming miners and oils. Whatever the reason for the underperformance last year, it may not be the start of a 1984 style malaise. Small cap returns are very volatile, and this chart, which compares returns on the Numis Smaller Companies Index with the FTSE All-Share, shows just how volatile. A good year can be followed by a shocker, and a forgettable one, like here in 1998, can be followed by one that's too good to miss, as in 1999, where returns reached 30% premium over the all-share. The message seems to be that if you want to capture small caps' long-term outperformance, you must be prepared to endure the occasional down year.